This is your LMAX exchange technical update for Tuesday, July 4th, 2017. Euro dollar. So while it would be premature at this point to suggest that the euro is stalling out now into this critical range resistance in the 115 to 117 area, it's going back to 2014 when the market started to consolidate to present day. It is possible that the market does stall out very soon as it's coming up into this critical resistance area. So it'll be interesting to see how things play out over the coming sessions, but it is clear that given this range that we've seen and given the move towards that range high, additional upside could be limited in favor of the next major downside extension. Overall, it would take a break back below some recent support at 111.10 to negate the constructive outlook that we're seeing in 2017 and put the official pressure back on the downside. So while we are seeing some setbacks right now, it's nothing more than a minor blip, and we would need to see a breakdown below 111.10 to really accelerate declines here. So at the same time though, the market is trading up towards this key resistance in the 115 to 117 area. So if we do see fresh upside over the coming sessions, look for those rallies to be very well capped up into that 115 to 117 area. Sterling dollar. So cable has rejected a break of the recent 2017 high at 130.48, preferring to pull back. Right now, the market is overall very constructive following the breakout in April above 127.75, which sets the stage for the next major upside extension towards 135. At the same time, though, we are seeing a bit of a consolidation post that breakout above 27.75, which could mean more up and down trade between 125 roughly and 130 before the market ultimately breaks higher. Any setbacks now should be very well supported ahead of 125 ideally, with only a break back below 123.60 to really compromise this more newly adopted bullish outlook for sterling dollar. Dollar yen. So dollar yen has extended its recent run, but it's important here to take a look at the chart going back several months. And overall, when you look at this chart, it isn't all that bullish just yet. The market would need to establish back above 114.37 to really suggest that the market wants to break out. And until then, this rally could easily be well capped again up towards 114 in favor of a bearish reversal back down towards a retest of the 2017 low, just shy of 108. Euro Swiss. So Euro Swiss has come up back above 109 in recent trade, but the market has shown a very strong resistance up towards that psychological barrier at 110, which it hasn't been able to break above. Overall, the longer term trend now continues to favor the downside, especially while it trades below 110, with risk for another topside failure and move back down towards critical support just ahead of 106. A break below some recent support at 108.30 would strengthen this outlook and accelerate declines, and again, only a clear break above 110 would force a meaningful shift in the structure. Aussie dollar. So Aussie dollar continues to show signs of being very well capped into rallies up towards the 78 handle, and we're seeing this again with the market stalling out above 77 and rolling back over. Ultimately, there's risk for a resumption of declines here to take us back down towards multi-day lows, which come in around 73.30, with a break below to accelerate declines, potentially back towards a retest of the 2017 low. Dollar CAD. So dollar CAD has seen an intense pullback over the past several days, with the market trading to a fresh 2017 low after trading to a 2017 high just back in the month of May. The 2017 low has been set just under 130, that critical psychological barrier, but there is reason if you look at this longer term chart to expect the market to once again be supported down around the 130 area in favor of a bullish resumption. Look for the market to establish back above some recent resistance around 130.44 to strengthen this outlook and open the door for an acceleration of gains. Kiwi dollar. So the New Zealand dollar has been trading up over the past several days, with the market rallying towards critical resistance just shy of 74 in the form of that 2017 peak that we saw in February at 73.76. But just like Aussie dollar, this is a market that continues to show signs of topping out and a more of a toppish outlook as it peaked back in 2016 and looks like it could once again roll over into this rally up towards the 74 to 75 area. This could lead to a resumption of declines over the coming weeks that takes us back down towards a retest of the 2017 low around 68.20. SPX 500. The S&P 500 has mostly been chopping around over the past several sessions since putting in a fresh 2017 and record high up just over 2450. Overall, while the market could be showing signs of exhaustion, there is no sign of any official reversal just yet, and the focus still remains on a potential fresh upside extension to fresh record highs in a measured move extension at 2480. Ultimately, it would take a breakdown below 2400 to take the immediate pressure off the top side, while a break all the way back down below 2320 would force a more meaningful shift in the structure. Gold. So gold setbacks have intensified into the new week, with the market pulling back into the 1220 area. But overall, since 2016, this is a market that's been very well supported on dips, making higher lows and higher highs ahead of the next upside extension, which could be now towards and through the recent highs from 2017 at 1296, exposing a retest of the 2016 peak at 1375 further up. So although we have seen some intense setbacks, while the market holds above 1200 and ideally above that previous higher low in the 1214 area from the 9th of May, there is risk for another well-supported dip ahead of a resumption of gains. Ultimately, it would be nice to see a break back above recent highs that we saw on Monday, which come in around 1243, to strengthen this outlook and accelerate those gains.